All right, let's jump right in. You know when you're watching a stock and it's in this amazing trend, just chugging along, and then it just stops. It starts going sideways. Is the party over? Is it time to get out? Or is the market just, catching its breath? Well, today, we're going to learn how to read those pauses. And that's the big question, isn't it? It's what every technical analyst is trying to figure out. That sideways chop can feel really confusing, but hidden inside all that noise are clues. And these clues often form specific shapes, patterns that can actually suggest the original trend is about to kick back into high gear. And that is exactly what a continuation pattern is. It's not the market changing its mind, it's more like a brief intermission. Think of it like a pit stop in a race. The car pulls over, refuels, and then gets right back on the track, heading in the same direction. That's what these patterns signal. This slide breaks it down perfectly. On one side, you've got our continuation patterns. Think of it as hitting the pause button. On the other side, you have reversal patterns, and that's a full-on U-turn. A really key difference here is the timing. Continuation patterns, what we're talking about today, they're usually shorter term, maybe a few weeks to a few months. Reversals, those take way longer to build and signal a much bigger, more fundamental shift in the market's direction. So if we want to get good at spotting these pauses in the action, we need a toolkit, right? We're going to break down the three most common and honestly most reliable families of continuation patterns you're ever going to see on a chart. First up, we have the triangle family, and I absolutely love this analogy. I want you to think of these patterns like a spring coiling up, just building tension, storing up all this energy for a really powerful release. You'll literally see the price get squeezed into a tighter and tighter range right before it pops. And spotting them is actually pretty straightforward. It's kind of like a simple three-step recipe. First, you absolutely need an existing trend. Context is everything here. Second, you draw two trend lines that are squeezing the price together. And third, and this part is super important, for it to be a real valid triangle, the price has to touch each of those lines at least twice. You need those 4 reversal points to confirm the pattern. Okay, now let's look at the 2 main flavors of triangles. Over on the left, you've got the symmetrical triangle. See how both the top and bottom lines are sloped and coming together? Now look at the one on the right. That's an ascending triangle, and it's got that really distinct flat top and a rising bottom. They both show the market consolidating, but they tell slightly different stories about who's winning the fight. And this quote right here just nails it. The symmetrical triangle is a coil. It represents this period of pure indecision. Buyers and sellers are in a dead heat, and you can see the volatility just shrinking and shrinking. But all that energy has to go somewhere, and it usually breaks out in the direction of the original trend. And here it is out in the wild. This is a real chart of Dell from back in '97. You can see that strong uptrend leading into the pattern, right? Then the price gets squeezed into that coil for a few weeks, and then bam! Look at that powerful breakout to the upside. Now here's the real tell. Look down at the volume bars. See how the volume just dries up while the triangle is forming, and then it explodes on the breakout? That's your classic confirmation signal right there. So the key is really understanding the psychology behind the shape. A symmetrical triangle is total indecision. Bulls and bears are perfectly balanced. But an ascending triangle, that's different. The buyers are getting more aggressive. They keep pushing the price up against that flat ceiling over and over. That's a bullish sign. And of course, the exact opposite is true for a descending triangle, where sellers are pushing down against a flat floor. That's a bearish signal. Okay, let's move on to our next category. If triangles are kind of a slow coiling of energy, flags and pennants are the market taking a quick, sharp breath after an all-out sprint. These things are fast. They're short-term, rapid-fire patterns. And here is the one thing you absolutely, positively must see before you can even think about calling something a flag or a pennant. You need a flagpole. That's a sharp, almost vertical price move that happens on really heavy volume. Without that initial explosion, you don't have a flag or a pennant. Period. It's the number one requirement. So how do you tell them apart? Let's break it down. On the left, you've got the flag. See how it looks like a small rectangle or parallelogram that's kind of sloping against the main trend? Now look to the right. That's the pennant. It's basically just a tiny little symmetrical triangle. The key for both of these is that they are super brief, usually lasting only 1 to 3 weeks at the most. Here's a textbook example on this chart of international paper. First, check out that massive, almost vertical flagpole run up. That's the explosive move. And it's followed by that short, orderly little pullback that forms the flag itself. What this really represents is just a quick pause, some early investors taking profits before a whole new wave of buyers who missed that first run-up jump in and push the price even higher. All right, our final pattern is the rectangle, and I like to think of this one as a visible battleground. It's this really clear, defined box where buyers and sellers are just locked in a brutal tug of war, and for a while, neither side can gain any ground. So by definition, a rectangle pattern is just a pause where prices bounce sideways between two flat parallel lines. You'll also hear it called a trading range or a congestion area. The bottom line acts as support, where buyers step in, and the top line acts as resistance, where sellers take control. It's basically a traffic jam in the middle of a trend. This diagram shows you the textbook structure perfectly. You have an uptrend, and then the price just starts bouncing back and forth between this really well-defined ceiling and floor. Traders are testing the boundaries, but for a while, the balance just holds, until, eventually, that original trend reasserts itself with a powerful breakout. And here's what that looks like in the real world on a chart of Compaq. The stock had this nice run up, and then it entered this 4-month-long trading range. For months, it was just sideways, boring chop. But this wasn't a reversal, it was just a very long pause, a consolidation, before the uptrend resumed in a really big way.
Phew. Okay. We've covered a lot of ground here. Triangles, flags, rectangles. So now let's just boil it all down into a few golden rules that you can apply to spotting any of these continuation patterns.
Okay, let's wrap this up with your takeaways. First, always confirm the prior trend. Without it, there's nothing to continue. Second, use volume as your lie detector. It should get quiet during the pattern and get loud on the breakout. Third, and this is so important, be patient. Wait for a decisive price close outside the pattern's boundaries. Don't jump the gun. And finally, remember the timeframes. It'll help manage your expectations about how long these things should last. Which brings us to our last question here. Learning to spot these patterns is a really powerful skill for sure, but it's important to ask yourself, are they crystal balls that perfectly predict the future every single time? Or are they simply tools? Tools that help us identify high probability moments in the endless ebb and flow of the market. It's definitely something to think about.